Good morning, and welcome to today's market and geopolitical coverage. The date is Friday, March 6th, 2026, and while much of the financial media's attention today is focused on the release of the United States jobs report, analysts are directing urgent attention to a separate development they describe as significantly more consequential for global energy markets, supply chains, and commodity prices. Overnight, a series of major developments have unfolded in and around the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's oil supply passes on a daily basis. According to reports, the strait is effectively closed to normal commercial traffic following a sharp escalation of military activity in the surrounding region. Qatar has announced a complete halt to crude oil production, stating that output will remain suspended until hostilities in the area cease. No timeline for resumption has been provided. Separately, Maersk, one of the world's largest container shipping companies, responsible for moving approximately 17% of global container freight, has officially suspended vessel services through the region, citing what the company describes as extreme military risks, including drone strikes, naval confrontations, and the refusal of insurance underwriters to cover the affected routes. The market response to these developments has been immediate. Brent crude oil has broken past $86 per barrel and is continuing to rise. Analysts note that the Strait of Hormuz, at its narrowest point just 21 miles wide, serves as the sole maritime exit for oil produced by Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Qatar. On a normal day, approximately 21 million barrels of crude oil transit the strait, representing 20% of global petroleum consumption and 30% of all seaborne traded oil. The disruption of that flow, analysts say, carries direct and measurable consequences for refining capacity, fuel availability, petrochemical production, and ultimately the cost structure of virtually every goods-producing industry on the planet. Silver is currently trading at $82.46. Analysts argue that this price does not yet reflect the supply chain and energy cost implications of what has occurred overnight, and that the relationship between oil prices and the cost of silver mining is the critical link that markets have not yet priced in. To understand the direct connection between the Strait of Hormuz closure and the price of silver, it is necessary to examine the energy costs embedded in the silver mining and refining process. Silver does not reach the market through financial engineering. It is extracted from the earth using large diesel-powered excavators operating around the clock. The ore is then crushed in energy-intensive milling facilities, chemically refined using processes that require significant heat and electricity, and transported across continents by trucks, ships, and aircraft, all of which are powered by petroleum-derived fuels. Analysts who track mining cost structures note that the average energy cost to produce 1 ounce of silver, depending on the deposit and the jurisdiction, falls between $8 and $12 per ounce when oil is priced at $70 a barrel. That cost baseline is the figure embedded in analyst models, Wall Street projections, and existing futures contracts. With Brent crude now above $86 and continuing to climb, that baseline is no longer valid. If oil reaches $100 per barrel, a level analysts describe as increasingly probable, given that 20% of global supply has been disrupted, the energy cost to mine 1 ounce of silver is projected to rise to between $15 and $18. If oil reaches $120 per barrel, which occurred during the last major geopolitical energy crisis in 2022, energy costs per ounce of silver mined could approach $25. That figure does not yet include refining costs, transportation expenses, insurance premiums on cargo moving through disrupted supply chains, or the additional margin that mining companies will require to operate under conditions of extreme commodity price volatility. The paper market is currently pricing silver at $82.46. Analysts argue that if the cost to extract, refine, and deliver 1 ounce of physical silver rises to $40, $50, or $60, the gap between the paper price and the true cost of physical supply becomes mathematically unsustainable. This is not, they emphasize, a theoretical argument. It is a supply chain cost calculation grounded in the direct relationship between diesel fuel prices and mining operations, a relationship that every senior mining executive understands, but which is not yet reflected in the current futures market price. Historical precedent supports the pattern. In 2020, when oil prices collapsed and briefly turned negative, mining costs dropped sharply, and the paper price of silver remained suppressed. In 2022, when Russia's invasion of Ukraine sent Brent crude to $130 per barrel, mining companies publicly disclosed unsustainable cost structures and began curtailing output at marginal deposits. The difference between those episodes and the current situation, analysts note, is the absence of available remedies. In prior crises, governments were able to release strategic petroleum reserves to dampen the price spike. OPEC maintained spare production capacity that could be deployed to offset supply disruptions. Alternative shipping routes existed that could absorb some of the redirected cargo volume. None of those options are readily available in the current circumstances. The Strait of Hormuz handles 21 million barrels per day. There is no alternative maritime corridor capable of absorbing that volume. Qatar has not provided a timeline for resuming production, and Maersk has not indicated when it will restore services to the region. Analysts also point to existing structural conditions in the silver market that predate the current crisis and which, they argue, make the market particularly vulnerable to an energy-driven supply shock. Global silver mine production has been essentially flat for the past 5 years, averaging approximately 830 million ounces annually. Total demand, combining industrial consumption, investment purchases, and jewelry fabrication, has been running above 1 billion ounces per year. That gap between production and demand has been filled by drawing down above-ground stockpiles, increasing recycling, and liquidating exchange-traded fund inventories. Those sources are finite, and analysts say the buffer they provide is narrowing. The additional cost pressure introduced by an oil price spike of the current magnitude could, in their assessment, push the market into a supply deficit that cannot be resolved without a substantial increase in the silver price. Beyond the direct mining cost implications, analysts outline a broader sequence of market events they say is already being set in motion by the Strait of Hormuz closure, a sequence that begins in the energy derivatives market and ultimately reaches the physical silver market through a chain of institutional responses. The initial reaction to a geopolitical event of this scale typically appears first in the oil markets, where Brent crude and West Texas Intermediate futures spike sharply. Energy sector equities rally. That surface-level movement is visible to most market participants. What occurs beneath it, analysts say, is considerably more consequential. Major banks, hedge funds, and institutional investors carry large positions in energy-related derivatives. Swaps, futures contracts, options, and structured products tied to oil prices. When oil moves violently, those positions generate margin calls. Meeting margin calls requires cash, and firms facing sudden cash requirements typically liquidate their most liquid holdings first. Those holdings include government bonds, large-cap equities, and paper contracts in gold and silver. This is the mechanism, analysts explain, behind the counterintuitive phenomenon in which precious metals prices sometimes decline in the immediate hours following a crisis, even when the logical expectation would be a rally. The selling is not a reflection of diminished value in precious metals. It is a reflection of institutional cash requirements driven by energy derivative losses. That selling pressure, analysts note, is temporary in nature. Once margin calls are satisfied and the immediate liquidity requirement is met, institutions reassess their overall risk exposure in light of the new environment. An oil price sustained above $100 implies accelerating inflation. Accelerating inflation constrains the Federal Reserve's ability to cut interest rates. A central bank unable to cut rates in a slowing economy produces the conditions associated with stagflation, a combination of rising prices and contracting growth that is historically destructive to traditional financial assets. Government bonds lose value in inflationary environments. Equities face earnings compression as input costs rise and consumer demand weakens. Real estate becomes less accessible as financing costs remain elevated. In that environment, analysts say, institutional capital historically rotates into physical commodities, with gold and silver among the primary beneficiaries. The historical parallel analysts cite most directly is the stagflation episode of the 1970s. In 1973, the OPEC oil embargo caused crude oil prices to rise from $3 per barrel to $12 per barrel in a matter of months. The economic consequences included double-digit inflation, rising unemployment, contracting GDP growth, and a sharp decline in stock market valuations. The dollar lost approximately 30% of its purchasing power over the subsequent years. During the same period, gold rose from $35 per ounce in 1971 to over $800 by 1980, and silver rose from $1.50 to $50, a return of approximately 33 times in under a decade. Analysts note that the current situation differs from 1973 in several key respects that they argue make the potential impact more severe rather than less. Global debt in 1973 was measured in the billions of dollars. Today it is measured in the hundreds of trillions. The financial system in 1973 retained some connection to hard asset reserves. Today it operates on a purely synthetic basis, dependent on central bank credibility and continuous debt issuance. China in 1973 was not a major participant in global energy markets. Today it imports more than 10 million barrels of crude oil per day, a substantial portion of which transits the Strait of Hormuz. A sustained disruption to that flow, analysts argue, would affect Chinese industrial output, global supply chains, and the prices of manufactured goods across every category. Silver's dual role, as both a monetary metal and an industrial commodity, creates a specific dynamic in a stagflationary environment. When economic growth slows, industrial demand for silver from sectors including solar panel manufacturing, electric vehicle production, electronics, and medical devices tends to soften as factory output declines. At the same time, monetary demand for silver rises as investors seek protection against inflation and currency debasement. Analysts argue that the net effect of these two forces, in the current environment, is a sustained elevation of total demand against a backdrop of constrained and increasingly expensive supply, a combination they describe as the structural basis for a significant upward repricing of the metal. The geopolitical dimension of the Strait of Hormuz closure, analysts further note, intersects with longer-term shifts in the international monetary system. The petrodollar arrangement established in 1974, under which oil-producing nations agreed to price oil exclusively in U.S. dollars in exchange for military protection and access to Western financial markets, created a sustained global demand for dollar reserves that underpinned American monetary policy for 5 decades. That arrangement, analysts say, has been under increasing pressure. Several BRICS member nations, including China, Russia, India, and Brazil, have been developing bilateral trade agreements that bypass the dollar. Saudi Arabia has held negotiations with China regarding yuan-denominated oil pricing. Iran has conducted oil sales settled in yuan and gold. The closure of the Strait of Hormuz, analysts argue, accelerates these shifts by forcing oil-importing nations to secure alternative supply arrangements, many of which involve non-dollar payment mechanisms. Central bank gold accumulation data is cited as evidence of this repositioning. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2022, the highest level recorded in decades, with the majority of purchases attributed to China, Russia, India, and Turkey. Those purchases continued through 2023, 2024, and 2025. China's official gold reserves are listed at 2,264 tons, though analysts estimate the actual figure may be considerably higher when unreported purchases by state-owned entities are included. Russia has increased its gold reserves from approximately 500 tons in 2010 to over 2,300 tons. These accumulation patterns, analysts say, reflect a deliberate strategic repositioning toward commodity-backed assets in anticipation of reduced reliance on the dollar in international trade. Returning to the immediate market implications, analysts draw a distinction between the paper price of silver currently displayed on trading terminals and the price at which physical silver is actually available for purchase. The paper price of $82.46 reflects transactions in the futures market and unallocated account structures operated by the COMEX and the London Bullion Market Association. The price at which physical silver, in the form of 1-ounce coins or bars from major mints, is currently available from retail bullion dealers is reported to be $6 to $8 above that figure, placing the effective physical price closer to $89 or $90 per ounce before any additional disruption-related premium increases. Analysts explain this gap through the structure of the COMEX futures system. The exchange issues paper claims to silver in volumes that significantly exceed the quantity of physical silver held in registered vaults available for delivery. Estimates of the ratio of paper claims to deliverable physical silver range from 100 to 1 to 250 to 1. Under normal market conditions, the vast majority of contract holders close their positions in cash without ever requesting physical delivery, and the leverage embedded in the system remains invisible. When institutional investors or sovereign entities begin requesting physical delivery in volume, the system faces stress. Analysts point to the March 2020 episode, when the spread between paper and physical silver widened to approximately $8 per ounce during a brief delivery disruption, and to early 2023, when physical premiums reached $12 above the spot price during the regional banking crisis. In both cases, the dislocations were resolved through emergency interventions and expanded vault arrangements. Analysts argue that in the current environment, with energy costs rising, supply chains disrupted, and insurance coverage for shipping through the affected region suspended, the mechanisms available to resolve a delivery stress event are more limited than in prior episodes. The COMEX futures pricing mechanism, analysts note, functions on the assumption that physical supply is accessible and that the cost to produce and deliver new supply is reasonably stable. When energy prices spike sharply, that assumption breaks down. Mining companies operating marginal deposits at oil-linked cost structures may reduce or suspend output rather than produce at a loss. Refineries dependent on stable energy input costs may curtail throughput. Transportation networks relying on diesel-powered logistics face higher operating costs that are passed through to end buyers. Each of these factors widens the gap between what the paper market says silver is worth and what it actually costs to acquire a physical ounce. Analysts describe this gap as the defining feature of the current market setup and argue that it cannot persist indefinitely without a correction in the paper price, a widening of physical premiums, or both simultaneously. The sequence of events analysts anticipate over the coming trading sessions begins with the Asian markets. The Shanghai Gold Exchange opens Sunday evening in North American time zones, and analysts describe that session as the first opportunity for price discovery in physical metal following the weekend escalation of events in the Strait of Hormuz. If Chinese buyers respond to the energy disruption by bidding silver higher in yuan-denominated terms, arbitrage flows between the Shanghai and New York markets would apply upward pressure on COMEX pricing. Analysts note that China imports more than 10 million barrels of crude oil daily, a significant portion of which transits the strait, making Chinese market participants acutely sensitive to the disruption's implications. In summary, the developments of Friday, March 6, 2026, center on the effective closure of the Strait of Hormuz, following an escalation of military activity in the surrounding region. Qatar has halted crude oil production with no stated timeline for resumption. Maersk has suspended container shipping services through the area, citing extreme military risks, drone strikes, naval confrontations, and the withdrawal of insurance coverage. Brent crude oil has broken above $86 per barrel. The strait handles approximately 21 million barrels of crude oil daily, representing 20% of global petroleum consumption and 30% of all seaborne oil trade. Analysts identify a direct transmission mechanism from elevated oil prices to higher silver mining costs, noting that energy expenses represent $8 to $12 per ounce of silver produced at $70 oil, rising to potentially $25 per ounce or higher at $120 oil. Against a backdrop of flat mine production, above-trend total demand, and a paper-to-physical pricing gap already visible in retail premiums, analysts describe the current silver price of $82.46 as one that does not yet reflect the physical supply and cost realities introduced by the overnight developments. We will continue to monitor this situation and bring you updates as market conditions evolve. Thank you for watching, and stay with us for continuing coverage.